Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 322 on May the 10th, 2024. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on Beyond Meat, Inc., New Holdings, and Alcoa Corporation, and we discussed three new trades on SoundHound AI, Bank of America, and the KraneShares CSI China Internet ETF. Now, it's always great to hear from listeners. If you have any questions about the trades presented here or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. And I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the markets finished the week higher once again. The Dow Jones Industrial average grew 837 points, closing on Friday at 39,512 points. The S&P 500 index picked up 94 points, ending the week at 5,222 points. And now it's time for the topic of the week. The topic of the week is the key to understanding options. Now, every now and then, someone will ask me to break it all down for them. Just make option trading simple. I totally understand. Sometimes learning to trade options felt like I was learning a new language. A lot of that had to do with the fact that when I learned, we also had to learn how to use the Greeks with every trade. That simply isn't required if you're not trading volatility. So how do I answer the question? I'll try to make it simple. If you understand what it means to buy a call option and sell a call option, and you understand what it means to buy a put option and to sell a put option, you can figure out every option strategy out there. It all comes back to which option type you traded and did you buy it or sell it. As an example, each week on the show, I give three trades: a covered call, a credit spread, and a debit spread. The covered call is easy. Most people already understand what it means to buy stock. So if you understand what it means to sell a call option, then you simply add those two together for the covered call. The spreads are pretty simple too. For both the credit spread and the debit spread, you buy one option and you sell the other one. Sometimes it's a call option spread, sometimes it's a put option spread. Even if I teach you more complicated spreads like ratio spreads, butterfly spreads, diagonal spreads, and calendar spreads, and we can keep going beyond that, they all come down to buying and selling individual options. So if you really want to understand options, you need to fully understand what it means to buy and sell a call option and to buy and sell a put option. If you want more personalized help, of course, and for all of this to make sense to you, send me an email and we can plan a coaching call sometime. So let's get into the review of last week's trades. We're going to start off on the covered call with Beyond Meat, Inc., symbol B as in Bravo, Y as in Yankee, N as in November, D as in Delta. At the time, the stock was trading for $8.23 per share. I looked at buying stock and selling the May 8.5 call at 99 cents, hoping for a return of 15.31% in 2 weeks. Well, shares of Beyond Meat lost $1.08, ending the week at $7.15 per share. The call option that we sold lost 84 cents, leaving us with a net loss of 24 cents if we were to close the trade out immediately. The stock drop was due to the earnings announcement that happened midweek. Now, typically, we would look to roll the strike lower to offset any immediate losses from the stock move. However, with 1 week left before expiration, I would lean more towards letting that option expire out of the money. This will allow us to sell another call option against the stock after expiration. You could look to sell the $8 strike on some of the weekly options and aim to collect roughly 20 cents per week, actually north of 21 cents per week. Or you can simply sell the $8 strike for the June 21st expiration at 49 cents. Now, I would lean towards trying to capture more profit by selling the out-of-the-money strikes to collect that 20 cents per week, and this could still turn out to be a very nice trade. If stock holds near current values or goes higher, you stand to make an even greater overall return, even better than what we initially planned. So if you'd like to simply close the trade, you can always roll the strike down to the $7 strike, which is already in the money. You'll collect enough premium to offset your initial loss, and you'll exit the stock at expiration on Friday. If that stock, of course, remains above $7 per share. Now, it would lower your overall return expectation, but you'd still lock in a small profit at this stock price, and you could walk away from the trade at expiration. It all really just depends on your goals for the trade. It's basically a choose your own adventure story. And that's what I love about options. Next up, we've got the credit spread on new holdings, symbol N as in November, U as in uniform. At the time, the stock was trading for $11.68 per share. I looked at selling the May 11 put spread at 16 cents. That could give us a maximum possible loss of 34 cents per spread. Well, shares of NU or new grew 8 cents, ending the week at $11.76 per share. The out-of-the-money put spread that we sold is still out of the money. However, new holdings will report quarterly earnings on Monday. That could add some volatility just days before expiration. So no adjustments are needed at this point, but you'll want to have a game plan together just in case the prices do drop, and you'll want to limit your losses on that spread. Or, of course, the beauty of trading spreads is that you know your maximum gain or your maximum loss the moment you get in. So sometimes just taking the maximum loss and moving on is actually the best answer too. Just depends on what happens on Monday and how you want to play out of it. But hey, you got to love earnings season. Gives you a little extra volatility, and we can enjoy that benefit from that in the options. All right, finally, our last trade from last week was the debit spread on Alcoa, symbol A as in alpha, A as in alpha. At the time, the stock was trading for $36.76 per share. I looked at buying the May 36 half call spread for 32 cents. That could give us a maximum gain of 18 cents, or that's the 56.25% return on capital in 2 weeks. Well, shares of Alcoa picked up 37 cents, closing at $37.13 per share. The in-the-money call spread we bought is even more in the money, and that means we're making money on this spread so far, which is a good thing. If the stock expires above $36.50 per share in 1 week, we'll walk away with the 56.25% return on our capital for only holding a trade for 2 weeks. That's pretty sweet. I like the sound of that, of course, and this has been a nice trade. So I'll keep an eye on the stock in the coming days just in case something crazy happens and I need to make an adjustment along the way. At this point, no adjustments are needed. Now, we are 1 week away from May expiration on Friday, May the 17th. The new trades on today's show will use the June 21st expiration for monthly options that expire in the month of June. And I have a confession. I don't always like making trades 5 or 6 weeks out. I kind of like that 4 weeks, 4 weeks left, maybe even 3. 4 and 3 are my sweet spot. 2 weeks and 1 week are higher risk, of course. And honestly, 6 and 5 weeks are higher risk too. You can have so much time that it's almost inevitable that you're going to need to make an adjustment on that trade. So, I always take these next couple of weeks. If I see something that's really sweet, I put it on. Otherwise, I'm watching it and seeing if there's a better time and a better price for me to put it on at. Remember that after expiration next week, so really a week from Monday, so think Monday, May the 20th, we're going to see the 50-cent strikes being priced, and some of the options or some of the opportunities will be even sweeter than they are right now. So with that all being said as a caveat, let's get into the new trades for this week. We're going to start off with a covered call on SoundHound AI Inc. Symbol S as in Sierra, O as in Oscar, U as in Uniform, N as in November. The stock ended the week at $5.09 per share. I'm looking at buying stock and selling that June 5 half call at 40 cents. That could give us a return of 15.91% in 6 weeks. Now you enter this trade by buying stock for $5.09 per share and selling the June 5.5 call at 40 cents. This trade makes the most money if stock prices finish above $5.50 per share. The break-even price on this trade is $4.69 per share. And in real terms, the stock purchase would require $509 and you'll collect $40 for selling the option. Next up, we have the credit spread on Bank of America, symbol B as in Bravo, A as in Alpha, C as in Charlie. The stock ended the week at $38.45 per share. I'm looking at selling the June 38-37 put spread at 33 cents. That could give us a maximum possible loss of 67 cents per spread. Now you enter this trade by selling the June 38 put at 79 cents and concurrently buying the June 37 put for 46 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $38 per share. The break-even price is $37.67 per share, and in real terms, you'll receive $33 per spread that you sell and have $67 at risk. And then our final trade on the week is a debit spread on the KraneShares CSI China Internet ETF, symbol K as in Kilo, W as in Whiskey, E as in Echo, B as in Bravo. The stock ended the week at $30.10 per share. I'm looking at buying the June 29-30 call spread for 61 cents. That could give us a maximum gain of 39 cents, or that's a 63.93% return in 6 weeks. Now you enter this trade by buying the June 29 call for $2.02 and concurrently selling the June 30 call at $1.41. This is a debit spread because we're buying the spread, and this trade makes the most money if stock prices expire above $30 per share. The break-even price on this trade is $29.61 per share. In real terms, you'll pay $61 to enter the spread, and your maximum gain is $39 per spread. So that's it for this week's show. Thank you guys so much for listening. If you have any questions about the trades here on the show, or if you have any questions about the technical analysis workshop from last weekend, I actually did not have it on a Zoom call. I recorded it for the guys and put it on a membership site, and we're doing a Q&A call on Saturday. So if you still were thinking about getting that, or you were interested, go ahead, shoot me an email soon. I'm going to be removing the webinar link off of the website, and from then on, I will also be increasing the price. So act now, or just hit me up in the future, and I'll let you know. All right. Hope you're having a great week. I hope you have a wonderful weekend, and as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.